But yeah, with that, I'll let Garrett get us started.
Awesome. Thanks, Tyler. I'm Garrett Watson, Senior Policy Analyst on our federal team at Tax Foundation. Happy to see you all today. And as Tyler just prefaced, we're going to be chatting about the individual income tax code today and covering basically its structure, major items to be aware of. We're also going to be covering a few other things. So we're going to review the individual income tax return, starting from the top and working our way through it, just the major items, so you get a sense of how individuals work through their tax returns and actually end up paying income tax to the federal government. We'll work through the major tax credits for workers and families, which are pretty central within the existing income tax structure. We'll also talk about how pass-through businesses interact with individual income tax code. As you may have learned last week, they're a pretty central part of how we tax businesses in the United States, so we'll cover a little bit of that. We'll also talk about some bigger picture policy areas that intersect with the individual income tax code moving forward. That includes the question of, is the tax code progressive? What is the relative role of the income tax in the federal tax code's progressivity? Just to get a good baseline of where we are today on that question. And then, of course, we're going to hit the giant elephant in the room, which I'm sure all of you are familiar with, which is the looming expiration of the individual income tax provisions that were originally passed in the 2017 Tax Cuts and Jobs Act, and cover some of the policy issues and trade-offs that folks will be dealing with between now and the end of 2025. So that's a high-level overview. If you have any questions at any point during the presentation, feel free to just raise your hand and we can address them at the time, or we can chat more at the end. So we'll get started. I thought it would make the most sense, to, considering it's the individual income tax, to address the question, what is income? That is probably one of the central policy questions when it comes to the income tax for policymakers. A large part of the regulatory process of the actual statutes comes down to defining what income is and what is excluded from taxable income, what is included, how we think about that. So just want to start at a very high level of the sources of income by income level. This is for 2020, and as you can see, a few trends here. One is wages and salaries make up the bulk of income overall. It's about 90% of total income, and that's especially true for those earning less than about $200,000, where it makes up somewhere between 65 and over 80% of folks' overall incomes. And then as income increases, you can see that investment income and business income become more important as sources of income. And that's important because we'll chat a little later about how different types of income are taxed differently. Most notably, of course, the taxation of investment income and capital gains under qualified rates and brackets that are different from the individual income tax rates and brackets. So that's something to keep in mind. And this is looking at the overall sources of personal income, and retirement income is another part of the story as well, from pensions, 401ks, and other tax-deferred retirement plans. So the easiest way, I think, to learn about the individual income tax system is to walk through how it works on the tax form. So we've actually produced here this nice step-by-step chart, which may be a little difficult to read from afar, but I'll just walk through the major elements you should be aware of. One is the definition of, at the top, and we'll go through the actual 1040 in a minute here, what is income as defined for tax purposes. And the major element to start is adjusted gross income, or AGI. Now, this is actually a narrower measure of income than you may see economists talk about, right? Economists talk about income, which may mean a few different things, right? We often define that as the change in our net worth, less consumption in any given year. That is not the same as what we're talking about here. This is defined, of course, statutorily and by the Treasury Department. And there are major sources of income, or things you may think of as income, that are not included in AGI. A really big example that's really important from a tax perspective in the US for federal revenue is the exclusion that we provide for employer-sponsored health insurance, which is not included. It is excluded from AGI and therefore from taxable income. Another way it's often framed is that it's considered a tax expenditure, and that is an exception effectively from a broader economically defined income tax, right? That is defined from a more abstract concept of income. And so we start there with adjusted gross income. Another exception to adjusted gross income are those contributions I just mentioned to traditional retirement accounts. So the way that works is you get an upfront deduction if you contribute to your traditional 401k. So that means AGI is not including that income that you are earning every year and you're allowing to grow without having that principal be taxed up front. Later on you're taxed when you withdraw it, but up front, your AGI is reduced because you're not having that source of income taxed when you contribute to the traditional 401k. The next major item on the 1040 that we'll go through in a little more detail here are the deductions. And so a deduction is an amount that is deducted directly from your income, in this case from your AGI. And so it's important to keep that in mind, because we're going to come back to credits, which are calculated a little bit differently. You may have covered that in a couple of previous sessions as well. And the big item here, of course, is the standardized deduction versus itemized deductions. And so the standard deduction is worth $14,600 for single filers, a little over $29,000 for joint filers in 2024. And that's taken in lieu of itemizing your deductions. So the tax code provides, as many of you are aware, right, a litany of specific deductions for specific expenses or for other uses of your income, which you can tally up. And for the most part, taxpayers would only find it advantageous to itemize your deductions if the value of those itemized deductions exceed the standard deduction value, if that makes sense. Otherwise, you're going to leave tax savings on the table. And a notable thing here is the 2017 tax law did double the value of the standard deduction, and that therefore reduced the number of filers who take the itemized deductions. Back prior to 2018, when the standard deduction was half of its current law value, it was a much larger number, upwards of a third of folks itemized. It's now been reduced down to about 10% under current law of folks actually itemize. The rest, the 90%, just take the standard deduction. There's some simplicity benefits to that, of course, and something to keep in mind as we think about itemized deduction tax policy. So I did want to give you, it's just another way of looking at it. This is actually on the 1040. It's a little more going on here, but generally following that same chart, working through the top with your wages to define your adjusted gross income. And then basically line 12 in bold here is the item where you calculate your itemized deductions, or you take the standard deduction. And that would be, you reduce your AGI by that amount to get to what we call taxable income, which is line 15 here. There's also a special deduction for pass-throughs, which I'll get to here in a minute, that you can also take. But this is basically the first half of the 1040, where you're just working through your various items of income that are actually subject to tax, and then taking your deductions, in this case either standard deduction or itemized deductions, and then getting to your taxable income. On the second half of the 1040 is when you then compute your credits and get to your actual tax paid. And so we'll touch on that. So that's here on the second half. Once you've calculated your taxable income, you've taken the standard deduction or your itemized deductions, you then get to your actual amount of tax. We now get to tax credits, which are really important. So credits are a dollar for dollar reduction in the amount of tax you actually owe. That's different from a deduction itself, which is reducing the amount of taxable income you have. So that's important, because credits, all else equal, are typically more valuable than deductions, because deductions are just reducing the amount of income you actually pay tax on. So that's an important distinction. Sometimes folks mix those things up, but they're actually very different concepts in tax policy in the way taxes are calculated. And so here, the major items you'll see, which we'll talk about here in a minute, are the child tax credit. There are a variety of other credits you can receive. For example, a credit for certain higher education expenses. There's a litany of other credits as well, including the EITC, which we'll chat about here in a minute. And so you basically take your amount of tax and reduce it by the amount of eligible credits to get to your total tax. And that's the amount that you actually are liable for in that year. At that point, as you can see under payments from line 25 on, you're then calculating your withholding. That's actually where the earned income credit comes in here on line 27 to reduce it further. And that's where you end up basically here's the amount of tax you actually owe. Here are the credits you can apply to that tax balance. What does that net out to? And the net amount is basically, comes out to either the federal government owes you more than you paid in, or you owe more to the federal government than you paid in, right? And so that's either a refund from the IRS or an amount that you actually owe at the bottom of the tax return that you would then remit. An important concept here is the idea of refundability, which is certain credits, including the earned income credit, and part of the child tax credit, can be refunded to the taxpayer in the form of a check from the IRS above and beyond any tax liability they actually owe. So if they owe $3,000 in tax and they have calculated they are eligible for $5,000 in credits, they can receive $2,000 back from the IRS in the form of a check beyond their actual tax liability. And that's an important concept, because it's effectively, when we think about it, it's a form of spending in the tax code, right? That $2,000 amount could be a form of spending, a program that's sent directly to folks outside the tax code, Instead, it's administered through the tax code during tax season. So when you hear about refundability, that's what we're talking about. It's amount of a payment, typically from a credit, over and above the amount of tax you owe in any given year. All right, so when we get to the actual payments of tax, when you get to your taxable income, what do you actually apply that to? So we talked a little bit about the tax base at a very high level. Now we got to talk about the rates and brackets. And another really important concept that a lot of folks in the general public misunderstand all the time is this idea of marginal tax rates. So as you can see here, we have a tax rate schedule. All this is applied to taxable income. So when we talk about your marginal tax rate or your tax bracket, we are applying a different tax rate to a different segment of income as your income goes up. So we have a graduated rate schedule here going from 10% at your first dollar and then escalating as you earn more income. But it's really important to remember that in the case of a single filer, for example, they pay 10% for your first $11,600 and then only pay 12% on the income above that. And so if you go to a net year bracket up to 12%, let's say you earn $15,000, you're not applying that 12% to your entire $15,000 income. You're just applying that marginal tax rate to the income between $11,600 and $47,150. Really important concept here because folks may think that they're going to lose money if they work more because they'll be bumped up a tax bracket. That's actually not true because it only applies it to the marginal dollar in each bracket. And that escalates up to 37%. That 37% is applied to income over roughly $610,000 for single filers, $730,000 for joint filers. We actually have a nice video to display this that may describe it in a couple different ways better than I can that we can play real quick.
Pop quiz. Do you know what tax bracket you're in? If you answered it depends, well, you're right, because parts of your income are probably taxed at different rates. Say you have $50,000 in taxable income. Today, that dollar amount lands within the 22% bracket. But that doesn't mean you pay that rate on the full $50,000. Let's explain. In the US, your federal income tax is calculated through a progressive, graduated rate system. Basically, if you make more, you're taxed more. Right now, we have 7 tax brackets. Each bracket covers a range of taxable income, and the rate for each bracket gets progressively higher. Any income within the range of the first bracket is taxed at that rate. The next dollar you earn over the first bracket falls into the second bracket, and only those additional dollars within that range are taxed at the new rate. This continues as your taxable income increases. So in our $50,000 example, this much gets taxed at 10%, only this much gets taxed at 12%, and only this much gets taxed at 22%. As you can see, whatever your top tax rate is, it doesn't apply to all of your taxable income, just the portion that falls into your highest bracket. When we understand how brackets work, we can better understand the tax impact of picking up a second job, putting in overtime, or any other ways we might increase our income.
It's worth pointing out, of course, that folks are seeing, just go back to this slide real quick. It lets me click on it. That there's still going to be some behavioral effect or incentive effect from going into a higher bracket, right? It's not because you're going to end up losing all of the additional income to tax, but you are going to receive less income net of tax than you otherwise would if you were in a lower bracket. So there is an effect here of having a progressive income tax schedule. It's just not in the way people think about it, right? Sometimes where they think if I'm at 37%, the entirety of my income is going to be taxed at that 37% rate. So most of us probably are aware of that, but it's always good as a reminder, especially for folks who may otherwise mix that up. All right, so I mentioned earlier that a lot of the income we have talked about so far, wages and salaries, right, benefits that are taxable, most business income is subject to ordinary tax rates. And so when we talk about ordinary income or ordinary tax rates, we're talking about that typical rate and bracket schedule we just walked through. But in the case of capital gains income, it actually works a little bit differently. So capital gains income is a gain from an investment, say a stock, where the value of the asset is greater than your underlying basis, or typically the cost of the asset when you acquired it, right? Simple idea of buy a stock for $10, you sell it for $15. That residual when you sell it is $5 that could be subject to capital gains tax. Now in the US, as is true in most countries around the world, we only tax capital gains when they are actually realized. So you may hear this idea, and this is common in tax policy circles, of changing the treatment of unrealized gains. Unrealized gains are gains that have not yet been realized. They might be marked to market, right? A stock is valued at $15 on the market today. You have yet to sell it, so you have an unrealized gain in the case of a $10 basis of $5. And so under the current system, that $5 would only be taxed when you sell the asset, realize the gain, and only with some exceptions where you can actually defer that gain, say with 1031 exchanges, you'd be subject to that tax. If you hold that gain for longer than a year, and in certain circumstances, this is also true of dividends, you can fall into what is known as the qualified income rates and brackets, and that's the rate and bracket schedule here. So over 1 year, holding on to an asset with a capital gain, when you sell it, you'd be subject to lower rates than under the ordinary income tax schedule. So in this case, folks earning between $0 and $47,000, a little over that, actually are not subject to tax on capital gains for taxable accounts. And folks between $47,000 and a little over $500,000 pay 15%, and over that it's 20% versus those higher rates. Also worth noting that this is actually fairly common in other countries where capital gains are taxed at lower rates than ordinary income. So a few different reasons for that. One is the part of gains are often just the values from inflation, right? So the value of those gains are going up nominally every year because of inflation, and we want some way in the tax code to adjust for that. And to do so, we may tax it at a lower rate. The other reason is corporate, as you learned last week if you were here, corporate equities, corporate income are already taxed at the entity level. So capital gains are actually another tax on top of that. And to ensure that the combined tax rates aren't too high, keeping it at 20% or below that can help mitigate a little bit of that double taxation. So that's the way it works under current law. The other item to remember here is there is an additional tax known as the net investment income tax. That's a 3.8% tax for those earning over $200,000, single, 250 joint. That's not indexed for inflation, so actually more and more folks are subject to tax every year. That's applied only to passive investment income on top of this. So the top rate is actually 23.8% federally, and then you have state and local taxes as well. Also, should of course mention, it's really important to remember the brackets and rates. The brackets for the ordinary income are inflation adjusted every year, and has been the case for the last few decades to ensure that inflation doesn't increase the amount of tax folks are paying, even if their real incomes have remained the same. That's been really important, of course, during COVID and afterward, as we've seen inflation rates increase to multi-decade highs. Another point, real quick, is that on the realization point, just so you're aware, there's this idea called the lock-in effect. You may hear of this in wonky tax circles. The idea there is if you have an asset where you only pay tax when the asset is realized, folks are encouraged, of course, to hold on to that asset longer than they may otherwise hold on to it, right? Because they don't want to pay the tax. And so that locks people into their existing ownership of certain assets, and that could be distortionary, right? There could be a reason why, absent that tax system, folks may sell that asset and move that money to somewhere more productive. You can't do that if, of course, you're discouraged because of the tax system. So that's just one concept you may run into or hear about in this discussion that's an important one to know about. All right. Any questions so far on stuff before we get into credits? Or does all this make sense? Sweet. So we can get into the credit side of things, which are really central to the tax code and becoming of greater importance over time. About 48 million tax filers through their returns claim the child tax credit. And so here, this is a big chart just looking at the way the child tax credit parameters have evolved from basically from 2021 onward. Most notably, of course, in 2018, the child tax credit, which originally was $1,000 per child, was doubled to $2,000. And we adjusted the variety of other parameters related to work and income requirements. Without walking through all the details of the CTC, it's just important to know a few things. One is it is a fully refundable, is a partially refundable credit for families. There are existing work and income requirements for folks. So the lowest earners right now do not earn, or those who have no earnings do not earn a child tax credit under current law. And it requires a minimum amount of income. Right now it's $2,500. And then it phases in as you earn more income. It is partially refundable. I believe it's $1,800 this year of the $2,000 can be delivered directly as a check to families. And for those with tax liability beyond that, it's up to $2,000. And it's just important to know just how much this has changed. Of course, there's been a big debate on the Hill and elsewhere on the change in 2021, which dramatically increased the value of the child tax credit, increasing its value from $2,000 to $3,600 for young children, $3,000 for older children. It also completely removed the work and income requirements so that any household could receive the full value of this credit, and it was made fully refundable. That only existed for 1 year in 2021. And of course, our proposal is to either bring it back in some form. This also has some TCJA expiration interactions, because next year, of course, the child tax credit, along with all the other changes, which we'll cover here in a minute, expire. And so the child tax credit will go back to its original value of $1,000 at slightly different phase-in requirements and work requirements, as you can see on the screen. And it will cost upwards of $1 trillion to make that policy change just under the 2017 tax law permanent. The ARPA policy is another about $1 trillion on top of that, all over 10 years, just to give you a sense of the costs involved with this credit. But it is of importance for families with children. And another sort of important point with this credit is it was used in TCJA and is seen elsewhere, in addition to the policy goals related to poverty alleviation or other goals, as a way to adjust the tax code for household size. So if you have more dependents or a larger household, some will argue that, hey, makes sense that we should have a change in tax liability on the basis of your larger household. We used to have a personal exemption that gave you basically another exemption, or it acts like a deduction based on your number of dependents. That was suspended from, I think it was like a little over $3,000 in 2017 to zero temporarily. And the increased credit basically came in and swapped out for that exemption. So there is a case from a tax policy perspective for the credit separate from those other goals. That's just worth noting. Of course, a lot of debate on where this credit should go moving forward. The other major credit worth noting about, of course, is the Earned Income Tax Credit, which was introduced in the late 90s as a way to encourage work. The way this credit works, you may have seen the famous sort of plateau charts where it goes up, trapezoid charts, where it phases in, has a plateau, and phases out. This is basically all of the parameters to create that. We won't go through it all, but there's a couple that are worth noting. One is you can see the income amounts at your maximum credit by number of children, ranging from $8,000 single up to $17,000. And then the phase-out amounts where they end. So that gives you a sense of who we're targeting with this credit, going from it ends at $25,500 for families with no children, over $66,000 for those with 3 or more children. This, as you can see, is sort of a mix of both a work incentive and a credit for families with children, because they get a bigger credit if they have more children. And it basically phases in with income at a few different phase-in rates. And so this is meant to be a way to encourage work within the tax code. About 25 million workers receive it. It costs it was about $62 billion in outlays in 2019. The average amount that folks get nationally is close to $2,500, to give you a sense of where of the amounts here. And the EITC has been expanded over time. It did temporarily expand in 2021 during the American Rescue Plan, and has since reverted to its original levels. One thing to note, of course, is this credit can lead to relatively high rates of misapplied payments, because it is very complicated, often depending on your dependent situation, making sure you claim them properly. So there are improper payments that often go out with this credit that GAO and others have highlighted, and it's an issue that's still being worked on. Another note, as my colleague Erica York discussed last week, is that a proportion of the income tax revenue is coming from pass-throughs. So this just shows the evolution of pass-through taxation, where you can see partnerships, S-corps. It's also true of sole proprietorships have really increased in prevalence over the last 40 or so years. C-corps have sort of stagnated. This is true for tax rate changes in the past, as well as for other non-tax reasons. And so we subject pass-through income to ordinary income tax rates. We do have a special deduction that was introduced as part of the 2017 tax law, known as Section 199A. Also, it can be a complicated provision, but the idea is you reduce the amount of income you pay by 20% for that qualified business income. That's a deduction of worth 20% of that income, subject to a variety of limits and rules to stop avoidance. And so that's another item that will expire next year, and could. The idea is trying to equalize the tax rates between pass-throughs and C corporations, because C corporations, as we mentioned last week, are subject to a permanent tax rate of 21%. Pass-throughs have a top rate of 37%. So there's some concern You don't want those rates to be too out of whack, otherwise there's going to be behavior to try to switch between entity forms to get the lower rate. So that the Section 199A deduction was a way of trying to get those tax rates closer together by entity form, but it does have the trade-off of some complexity, and it's of course it's temporary. Shifting a bit, unless folks have questions on the existing sort of high-level credits, did want to chat a little bit about progressivity. This is a high-level view of the progressivity of the overall federal tax system, going from the bottom 50% upwards to the top 0.01%. As you can see, the dark blue is the federal income tax. It is highly progressive. It's actually one of the most progressive across industrialized countries in the world, as measured by the OECD. And you can see here, it's actually negative for the bottom 50%. That's those refundable credits we chatted about earlier. And then it escalates as income rises. And there are, of course, other components of the federal tax, including the payroll tax, which is that light blue one, which is capped at a higher income level, about $165,000. So that's why it's dropping as you go up the income ladder. And then all the other taxes are really fairly de minimis, including estate taxes, other federal taxes, and you have the corporate tax in there as well. But just worth noting, the overall federal system is progressive, going from about 6.3% at the bottom, upwards of 33% at the very top, especially when you include the impact of those tax credits. Another way to look at this, last year, Tax Foundation, we released a study looking at basically all of the tax and transfer systems across the U.S. to understand, in this case, these are basically the effective tax rates, where a negative rate is a transfer net of tax, a positive rate is collections over and above any transfers each quintile receives. So at the bottom, basically and one way to interpret this is for every dollar in tax a quintile is paying, they're getting $1.27 back at the bottom, and it then goes to negative 30% for the second, escalates up to 30% at the top. So it's just another way of showing that the existing progressivity of the system, including state and local taxes, and that it's doing its basic job. There's still debates, of course, about whether or not there should be even more progressive, but starting from a baseline understanding that the system is progressive as it's currently constructed, it's pretty important. All right, so a few more items here to cover. Of course, the big item here from a policy perspective that's going to interact with individual income tax policy over the next year plus is the looming expiration of the 2017 tax law, commonly known as the Tax Cuts and Jobs Act. It was enacted in 2017, as most of you know, and it did only temporarily change all of these individual income taxes, and we'll cover some of them here in a minute in a chart so you can see them all. The corporate side, it's less of an issue because most of that was made permanent with some major exceptions. I think last couple of weeks, we talked about cost recovery, bonus depreciation, which applies to pass-throughs and C-Corps, is phasing down, right? R&D expenses are now amortized over 5 years. So really important business provisions that are temporary or have already expired are going to could be taken up, but on top of that, we have this looming cliff for the individual side of things. And overall, it's important, of course, to take all those changes in combination. So when you combine all the tax changes, there were some major tax cuts, there were some tax hikes, right, by doing things like capping SALT at $10,000 for that deduction. But overall, it cut taxes for 80% of taxpayers. It raised taxes for 5% of taxpayers. That's confirmed roughly by the Joint Committee on Taxation. And because we did things like double the value of the standard deduction, it did simplify the system for many taxpayers who otherwise would have itemized, for example. And so we're seeing a lot of these things expire at the same time at the end of 25. Before we get to the specifics of what's expiring, I want to give you a sense visually of the average tax rate and how it changed over time from on the left here to the bottom 50% going to the top 1%. This is basically by year. So the pink is 2017 over to 2020. And as you can see, average tax rates went down across the board for filers of all incomes. 2020 is interesting because that also includes the COVID relief in those calculations. So here are the major items. A lot of this might be a review of the first few are the business provisions I just mentioned, of course, which you sort of went into more detail last week, but the R&D expensing, the interest deduction becomes a little tighter. Those both have already taken effect. Full expensing for short-lived asset expenses has been phasing down this year. 60% of those expenses, and it'll go down to 0% by the end of 2026. And then there's all these individual items I just want to mention, right? So the increase in standard deduction we talked about reverts back to where it was before. The personal exemption, which existed under prior law, will come back, and the CTC will revert back to its lower level, which we just chatted about. In addition to that, some of the base broadeners will revert back. So there's a current $10,000 limit on your state and local tax deductions. It's known as the SALT deduction. It's been the source of a lot of controversy and debate over the last few years about what to do with this. That expires and will go to a full deduction starting in 2026. The mortgage interest deduction, which was reduced from $1 million to $750,000 in home value, will revert back. The alternative minimum tax, which is a complicated minimum tax that we don't have to get into right now, that comes back. The parameters were reduced so fewer people fell into the AMT. The pass-through reduction we talked about expires, and the estate tax also the exemptions for it were doubled. That will also expire. So there's a lot going on here amounting to trillions of dollars in tax changes over the next few years. We did create, real quick just to highlight here, a tax calculator where folks can actually go in and calculate for any individual tax situation what expiration would mean. So just want to give a minute to show what that looks like. Back this over. You can find this on our website. It's on our front page. And folks can actually come through and calculate. I'll try to do this without having my back to y'all. We have individual scenarios here where you can calculate or just see for yourself. For this guy, this person has $30,000 in income. They would see a $250 tax increase roughly. And so it gives you a sense of permanence. You would pay $5,800. Expiration, $6,050. We'll see a tax hike compared to the scenario where TCJA is extended. This isn't universally true. As I mentioned, 5 or 10% of taxpayers may see a tax hike if it's extended, and people can run those scenarios to see who gets a tax hike. We also allow the ability to create like a custom scenario. So if you want to plug in your specific situation, if you're single, married, filing jointly, and which itemized deductions you have, your different income sources, to actually see how that might impact various folks. And this could be helpful in trying to see what that looks like in more tangible terms than the abstract tables you may otherwise see. Let's see here. Oh, that's from the start. All right. So real quick, we did some modeling on this, and we have a full paper you can take a look at. I do want to highlight a few things on. Okay, we talk about permanence could be an option. It's one of many options for the TCJA, of course, and I'll cover some alternatives here in a minute on the hard trade-offs of the situation we're running into in 25. But just to give you a sense of what we're dealing with, I think it's a good baseline. Here's a summary of the sort of revenue costs over 10 years. We're looking at just the individual side. So this isn't all of it. This is just the individual provisions we've mostly focused on. It would reduce revenue by about $2.6 trillion overall over the next 10 years. And so the lower rates in the wider brackets are the largest component of that. It costs about $2.1 trillion a year. The standard deduction costs about $930 billion over 10 years. And then there are, of course, certain base broadeners, including the SALT deduction, the mortgage deduction change, and other base broadeners that offset some of that. The net impact is about $2.6 trillion over 10 years. And so overall, the tax reductions are about $5.6 trillion of tax cuts, and then another $3 trillion in revenue raisers is another way to think about that. And that nets out to that $2.6 trillion with SALT and mortgage interest deduction and things like eliminating the personal exemption being the revenue raisers. We do find overall there would be economic benefits of permanence compared to current law where it expires. So we find that it would increase long-run GDP. This is using our macroeconomic model, which Erica demoed last week via our web model. It would increase GDP by about 0.5%. It would create about 686,000 full-time equivalent jobs. And so that's that amounts to hundreds of billions of dollars in GDP every year if you convert it into nominal amounts. So not insubstantial. And the big reason why that happens in our model is because you're reducing those ordinary income tax rates, you're widening the brackets. That reduces the marginal tax rates on work, and that generates more output in the long run. There is some offsetting effect from the base broadeners, right? The SALT cap and other things are real tax hikes for those folks on the margin. But that is offset, more than offset by those other tax changes that we're paying for. Though, of course, this is, in this case, a deficit finance tax cut, and that does come with some trade-offs. And then here, sort of consistent with what you may expect with TCJA permanence, it does, in 2024, of course, it hasn't expired yet, so we score that at 0. The last two columns, you can see, on a static basis, holding the economy constant, in 2033, you would see a tax cut across the board. In the long run, if you include the benefits of a larger economy, you also see a slightly larger increase in after-tax income for folks across the board, ranging from 1.6% or 0.9% upwards of 3.9%. All right. So a couple of notes on how we think about or prioritize these things, because this is a deficit finance tax cut, right? And there might be desire to prioritize certain provisions or offset provisions in whole or in part. So one thing that we've been emphasizing is making sure that we are prioritizing tax efficiency, meaning for every dollar of revenue we lose, we should maximize the amount of growth we get. That's one consideration among many. So what we did is we ran through our model. Here's the growth effect of a tax change. Here's the revenue loss. This is sort of one way to visualize that. On the right are the provisions that have the largest change in output per $1 billion of loss. And the left, it's less so or even negative. As you can see, if you're familiar with our work, we find that the business provisions are actually the biggest gains in economic output for dollar loss, including full expensing, the interest limitation. But there are certain items on the individual side worth pointing out here. As you go left, you can see the ordinary income tax rates and brackets are there. The repeal of what was known as the P's limitation, which was a certain limitation on itemized deductions, seems to be impactful. And then you can see further left here, a bit less, the 199A deduction, the estate tax change. And then you can see here the standard deduction has almost no effect. That has its own benefits, though. This isn't only one criteria for determining what to do. The standard deduction has benefits in the simplicity side of things over and above growth. The AMT is its own little story, which we'll talk about in questions or another time. That's a story about the average tax rate is going down. It's a tax cut, right, to make permanent the AMT changes, but it actually raises marginal tax rates, and that's what matters for economic activity and behavior. So that actually has a negative economic effect. You can chat more about that if folks would like. Another major item, we were remiss if we didn't mention it, of course, is the importance of trying to secure the wins we've already had on broadening the tax base, while also thinking about further base broadening. That may be required if we want to avoid increasing the deficit. And so just to have some ideas, right, among many others that have been thought about, ranging from the more incremental to more transformative. So, eliminating the SALT deduction is an option, or making permanent the existing cap, changing the mortgage interest deduction to make it less generous, or eliminating it altogether, right? Thinking about the capital gains exclusion on principal residences, that's another expenditure that could be considered, as well as the tax treatment of employer-sponsored insurance and fringe benefits, which does amount to trillions of dollars in lost revenue over 10 years. So some of these, of course, range from incremental to altogether politically infeasible right now, but they do give you a flavor of the various options here. And of course, these changes could and should be paired with other reforms to the income tax to ensure that, of course, if you're broadening the base, to keep those rates low or lower than right now, making sure that the tax code is simpler. We have done a couple of exercises as a way to illustrate through our growth and opportunity plan, which has a more transformative impact on the tax system. And we're also working on a few other more incremental options to show the trade-offs here. But these do have very real trade-offs in terms of the distribution of the tax burden and the state of the tax system moving forward. So it can be painful to get here, but then again, it will be painful to enact a deficit finance tax cut as well, potentially, depending on where we're at fiscally. So just a high-level mention there of that idea. And so I just want to summarize and wrap up the major items we talked about here today. Just things, if you take away anything here, that income taxes are applied federally in a graduated fashion as a marginal tax rate. So the dollars are applied above each threshold and not to the entirety of the income earned. Now the tax base does include a wide variety of types of income: wages, interests, dividends, capital gains, business income. But there are a lot of tax expenditures within the income tax code, right? Both from the various deductions, various credits, and even baked within the definition of income, right? Like that exclusion for the employer-sponsored insurance that are important to remember. That's an area for reform. Speaking of credits, of course, there's substantial payments to workers and families with children through both the earned income and child tax credits, and there's deep debates about how to reform those credits so that they themselves are simpler, so we have fewer misapplied payments, and we ensure that work isn't discouraged either, while also addressing other goals related to poverty and support for families. Also important to remember, there's a variety of ways you can show that the individual income tax specifically and the federal tax code more generally is progressive. And important to keep that baseline while we have debates about taxing folks at the top more or thinking about fair share. Having that baseline is an important fact that's sometimes missed in these discussions. And that making permanent the TCJA individual tax cuts would be pro-growth. It would come at a revenue cost, and there are options to deal with that, but there are hard trade-offs to be made that policymakers have to grapple with over the next 18 months on the proper balance of either new offsets or retaining current offsets compared to financing the tax cuts through deficits. And that's true both of folks who want to make the full TCJA permanent as is or make it permanent only for middle-class earners, right? So for those who earn less than $400,000, that's about 75% of the cost of the existing TCJA. So these trade-offs exist on a bipartisan basis across the spectrum that folks will have to deal with. And one fact I mentioned earlier, but just to put the income tax in its proper context, it raises about 52% of revenue compared to all the other income sources. So it's we're talking about over half of revenue collection every year. And well, that's why it's important to know something about it. So those are the major items. I know we walked through a lot, but happy to chat further or take questions. Yeah.
Curious, you have a revenue estimate for TCJA individual extension at white people over thousands level?
We're just talking about releasing a formal estimate on that. We were just talking about releasing an estimate on that potentially moving forward. We haven't done anything yet. Yeah. Right. Yeah, I think they put out like 1.4 or something. The big thing there is just deciding it's a bunch of small policy design decisions on certain things to comply with that or how you might do that. The rates and brackets are obviously very easy, but there may be a variety of others that you have to make interpretations on. But we would like to do that to give fuller context on what that would look like. But my understanding is somewhere between 70 and 80% of the total cost over 10 years. Yeah.
Kind of curious on scoring. We didn't start doing, even CDO didn't start doing 10-year out until 1995 for request.
Yeah.
And then we didn't start doing 10-year budgets till the year 2000. And those of us spent time in finance and business survey, they did life. Nobody uses a 10-year forecast or anything, right?
Yeah.
Math is whatever. And so to me, it's a little frustrating to look at how TCJA is scored. These long tail hypothetical, and COVID notwithstanding, the tax revenue is still out the fold. When I look at the numbers, when I've taken CDO's original projection, June of 2017 before TCJ, right? You line those numbers with CDO's updated outlook. It has outperformed expectations, COVID notwithstanding. Right, $7 billion dumped up the front. So I'm just curious to the Tax Foundation's perspective, and how do we go back to, how do you feel about your 10-year model versus CEO, and that should Congress not be pushing back for 4 or 5 years, something that's, because he's become a political football.
Right.
It gets its 1 tour, now it's around this theme for the last 6 years of election cycle.
Yeah.
I just think it's disingenuous to the public to use voodoo as.
You're right. Yeah, and it's especially true if you have temporary things, right? It's only covering part of the window. So as the window changes, these numbers change. So then it becomes unclear, like is that 6 years worth of policy? Is that 10 years worth of policy if it's only for part of the window? So that's the other problem. Then people mix that up with dividing by the 10.
The window.
Right, exactly. So you have that issue. That's a big one. For us, it's always been balancing, because a big goal of ours, of course, is to adopt the best practices of CBO and JCT so folks have a comparable use, right, here and elsewhere. But we also try to, say, hey, are there practices that are better to drive forward the conversation? We saw that, of course, with dynamic scoring being the most notable, but there may be others to think about on, what is the proper window? We, of course, use the current law baseline, which is consistent with how JCT and CBO do it, but of course that has its own trade-offs as long as you're being consistent and clear about what baseline you're using. So that's something, we grapple with all the time on presentation. The other thing, of course, is, and this is something our President Daniel Bunn has mentioned, is people will, and you're seeing increasingly, right, mess with using a current policy baseline or a current law baseline depending on what their political goals are, right? So they won't score certain things in the 10-year window, TCJA permanence being one of them, right? We saw in the fiscal year 25 budget, And that gives an incomplete picture on top of everything you're just saying, right, of what the actual costs are long term. Because we all know that's the intention is to make 80% of those cuts permanent. It's not being booked on the budget. That's a problem, in addition to the 10-year revenue issue. Yeah. So lots to think about there.